So today on the investing front, we're going to talk a little bit about risks, a little bit about something called correlation, which just is a connection between how similar are things you invest in, or how different are they, and how that can be a positive or a negative for you, and attempting to time the market, which people have been trying to do forever. Not usually the easiest thing to do, if a wise idea at all. I've got proof for that coming too. So, as we get started today, maybe. There we go. So, today, our quote of the day is, the stock market is a device for transferring money from the impatient to the patient. Because most of the time, people are like my son. They get hold of some money and they immediately want to spend it on something. Whereas the stock market, your money just kind of stews there for a while most of the time and just keeps larger and larger. And those are the people who make all the money. So, Warren Buffett, if you have not heard of him, not the richest man in America, at least not anymore, but again, greatest investor mind. There's a short video I've got with this that describes how he actually got started with his investing back at the age of 14. And when you see how much he's worth now, I think you're going to be surprised. And I have to make sure I've got the volume turned up here. Just one moment. There's always got to be something that Hardy does strange. All right, there we go. All right.
Today's episode is brought to you by Audible. Get a free audiobook with a 30-day trial today.
This is going to be the greatest video I've ever done. Why is this squishing? Oh. Normally I get options to full screen, but that's okay. We're going to keep rolling.
Exhausted father working many jobs to find work. It does Hopefully declare one night after your tail that you will make his first age or of a specialty. As he collected, then repeat the process. Stock prices from his father's $1 million in opportunity to invest. Assets such as multiple rates. Assets in $50 by the time he was 15. 40 1-acre farm in Nebraska and hired a laborer to work on the land. After graduating from high school, he a Bachelor of Science degree from Nebraska. Graham, as he left home to New York for business, he had the food. Which would place up at school. Warren briefly returned home. Analyst. Focus earnings on his investments alone. He would have to be far more active to meet his goal. Building and tangible assets. Berkshire Warren, Everson, very standard offers, but sense. I'm sure this is one of the folks. Five years focused all his efforts on developing Berkshire. 1979, pumping 600 $1 million deal in exchange for 25%. Never closer to his $1 billion. With Berkshire Hathaway share Lessons learned as a child, preference for businesses with tangible assets and proven earning power. Companies in the world. With Warren Buffett at its head, he would grow his personal fortune. 4.7 billion. World's richest man, given into the sun. True capitalism successful.
So the biggest thing possibly to learn from this is, I mean, think about what he did. He went from selling newspapers, bought land, figured out how to do that, started buying businesses. Notice the businesses changed too as he was working on this stuff. He went from, media to textile to cola companies to, he kept finding where the value was and worked at it. So again, it just goes to show the harder you work, the better off you're going to be. So a couple of things with vocab, not as much as yesterday. Market cycle, which we're going to talk about here momentarily. Passive versus active investing, a little more interactive. And then some things with trying to keep your diversity going, which Warren Buffett did quite a bit. I'm not going to actually have us go and do the article. I've got a link in here that I'll post over there too if you want to look a little bit deeper. But I do want to tell you a couple of things that'll kind of help here with these questions. And I am going to pull up the figures in a minute so we can see what they look like. So whenever you talk about the stock market, it runs in cycles. So what we mean by that, I actually have a figure I want to show you on this. So, for instance, here, this is just a regular chart of the stock market, okay, for like the last 10 years. So you're like, okay, I mean, it kind of is going in its way, but, what's this cycle thing? If you narrow in a little bit, what you can start to notice is when you start to get towards a new year, so like here's January running through here. Typically, your markets start to cool off as the year goes on. And as you get towards the next one, once that new year comes, sometimes you start to see a jump. Then it starts to fade again. So it's like it doesn't go up forever. It does kind of start to come down, and then it will hit that certain point and start to rise. Now, what causes that? It can be different events that happen in a year. If it's a different company, maybe their sales are better during one type of year, one time of the year than another, or something like that. So when we talk about cycles in this stuff, what we're talking about mainly here is your price. Why did it go away? Oh, because I hit the wrong button. Your prices go up and down with certain times of the year. It's not like you put your money in the stock market and it goes up every time. So it'll go through the ups and downs. We just got to kind of stick it through. So when you're looking, though, at average returns, because I talked yesterday about how it can be 10% and how that's not necessarily always going to be true. So down here, so many things. I have so many good ideas on them. They go haywire on me. There we go. So what you'll look at is within a period, okay, of the 500 biggest companies in America, there have been years that you've made a 54% profit. That's awesome. There have been single years that you have a 40% loss. That's not so good. And so the longer you hold something, 1 year to 3, yes, it's less up here, but it's also less loss. A little less gain, but a lot less loss. And by the time you get out to 10 plus years, check it out, you can barely see anything below in the negative part. Everything's positive. It's like from 3.1 to 17.9 if you hold it for a long time. If you're trying to get rich quick, you might get poor real quick. And so the biggest thing with that is always going to be when you're trying to figure stuff like that out, okay? The longer you hold, the more steady you are going to make an investment. It won't be as huge, but it's going to be ahead. Since the inception of the stock market, it's averaged over 10% a year. Are there years it's negative? Yep. Are there years it's really positive? Sure are. But over the long period, you're going to be good. And so the only other piece of this, I'm going to go back to that article one more time here. For one more piece, and try to stay away from my writing at the bottom, is sometimes people think that they're going to be smarter than anybody else. And hey, I'm only going to buy when prices are really low. And I'm only going to sell when prices are really high. And in theory, that sounds awesome. But here's the thing. For the last 25 years, this is a little bit further back than we're at now, yearly, about an 8% gain. If you take out the top 10 days that they ran up, now it's down to 4.1. What if I didn't pick one of the top 10 days and I tried to jump in? I probably didn't make as much. What if I tried to jump in, once every 30 days? Check this out, the top 20, 30, 40 days. Notice how little or how much of a loss I start to take. It's not worth trying to time the market, because if you do, more than likely you're going to miss one of the biggest days as you're going along. So again, don't try to time it. Just invest. Invest regularly. If you invest regularly over time, you're going to make money. It's just going to happen. There's very few ways, if you're well diversified, that's not the case. And so, when we're trying to look at how do I do this diversification thing, we talked a little bit about it yesterday. So the market cycles, again, they go up, they go down, sort of like that graph that I showed. But over the long run, that very first graph I showed you, when we stretched it out, it looked like it goes up nonstop. It doesn't. There's dips. But as long as you stay in the market, you're not going to be in bad shape. So again, over time, last 25 years, in general, we're just going upward. There's the little dips here and there, but that's why we're always going to have money in, to make sure that we don't avoid the highs by trying to miss some of the lows. And I'm not, don't worry, I'm not going political on you here. But a lot of times, especially during election years like this year, we'll get into things where, well, if this person was in office, this wouldn't be happening. And if this person was in office, this wouldn't either. Well, here's what the data shows. So again, over that 25-year period here, well, actually this one's a little longer, into 30, you've had times where both parties have flatlined. You've had times where parties have had great increases in things. It really doesn't matter. Over the long haul, we still make money as long as we're in the market. So don't worry so much about what's going on in the ballot box as you do investing in good things and kind of keeping yourself spread out with that. So, okay. Again, here's our biggest thing, our biggest takeaway with stuff. So I passed forward myself because I started going ahead. So, here. So, passive investing is also called buy and hold, which is exactly what it sounds like. You buy it, you hold it. for a long time. Because again, you don't want to be the person that's worried about those 10 to 12 days where most of the gains are made. People are not that good to guess, so you want to be in all the time to make sure that you're going to be part of that. So again, if you're holding your investments a long time, here's the other thing. When you hold them longer than a year, your tax rate that you will owe on them goes down. You owe less, usually about 10 to 15% less. It's called long-term versus short-term capital gains. So another improvement for holding them is that you don't have to pay that much. Now, active investing, which is what we call day traders, are in this for the short term. Like they're going to buy and sell within a day, within a week, within a month. They're not looking for things as long term. And as we can see, that's riskier because if you don't hit those dozen or so days, you're probably going to end up losing money. I mentioned that before. The fancy name they get are day traders because typically they just buy, sell, buy, sell, buy, sell within a day. And some people are successful. Again, some aren't. Got to pay more taxes called capital gains than the passive ones. And again, typically they are going to do worse in the long run. Every time, no. I can't say every, but for a majority of people, that's going to be what you want to be looking at. So, I don't want to be marking all those out here as we go. So let's kind of get these out of the way. I would say that probably 95% of the people that invest would go long term. They save this other stuff for the fancy professionals here. So, one of our last things to kind of chat through today is this thing called risk and tail risk. So, you're always going to have some risk. Even though it looks like that chart looks great, it does over the long run. But some common ways that you could lose money with poor business decisions. You could have somebody in the top of a company who does something underhanded or steals from the company or does something to jeopardize the company. You could have reasons like political events, wars, natural disasters that like ruin your business and break down your building and you don't have the proper insurance for it. That's smaller, rare things. It's not as big of a deal with stuff. But it does happen sometimes, but not very often. And so when we're looking at these things long term, awesome. Have a good weekend. So in math, if you ever take a statistics class, this is what a bell curve is, and most of the time when you have data, most of what occurs is going to happen here in the middle, and as you get further away, it's more and more rare. So again, these tails, like 0.2% of the time is when this crazy stuff's going to happen that's outside the control of the business. So it's not something we worry about too much. Diversify. Get your little baskets of everything going. We don't want to put all of our money in one stock, even like we are kind of with our little contest that we're doing. You want to have a little here and a little there, which is why we like mutual funds and exchange-traded funds. Put options I'm not going to get into a whole lot. That's kind of a little crazy. This last one I'm just going to talk about quick, though. Assets with less correlation. So, okay, what does that mean? I'm going to show you this big crazy chart, but I'm just going to explain it a little bit simpler than we normally would with something. What you're looking for here is you're looking to have different colors, a different color mix of things. So like for instance, if I'm going to go through and invest in, let's say, some energy stocks, okay, this deep green, when I'm going to invest in other things, I want to make sure I'm not getting more green. Maybe I don't want to get into an industrial or a financial because they're too interlocked. So maybe I do something in yellow and one in orange. Even one in red, you're like, Hardy, that's a negative. Up and down, remember. We're just wanting to diversify and make sure we're getting into different places. So you wouldn't want to buy 4 funds that all have Coca-Cola in it because you like Coca-Cola. You'd want to mix it up a little bit, get some other things. Get a little Coca-Cola here, get a little bit of Walmart over there, and some things like that to make this go a little easier. So, again, if you're invested in all the same color, you're at risk. You can make a lot more, but if they're going bad, you could also make a lot less, or even lose money. So we don't want to get too crazy with that. So the last thing, and again, this isn't to scare you, but it's to get you more to think about things, because there's a lot of people out there that like to do get-rich-quick schemes. So one way you can make money is by what's called stock shorting. And so that's when you're betting against a company. You're actually hoping or thinking their stock price is going to go down. So what you do, and this is just a general, I've got another tiny video that explains this simpler than I can, which is why I use it. You borrow shares of a company, so you buy them at a certain price, then you sell them right away to someone, and you buy shares later when the price has dropped. Oh. If not, you're going to owe the difference, and that can get to be a very pricey proposition as well. This one's shorter than the last one, but it kind of lets you see. So that is not something that we normally are going to tell people to do on their own unless you know something that somebody else does not know. Oh, no, don't do it again. We're going to go to the next one here. Okay. So, real quick, I'm going to give you some info on two companies. Now, think about for a minute which one you think would be better to short. A company that rents DVDs, yeah, this is old, and other movies to people's house. The stock of the company is down nearly 20% in the last 5 months and has dipped below where it was 4 years ago. The company announced plans to move away from their core business, but customers have expressed anger over the moves despite thinking the move is smart. A handful of professional investors have publicly recommended selling the stock. Now, this is sounding a lot like that one in the example. People are saying sell it. It's down. Ooh, I'm going to make money on this. But hang on. Company number 2. The fourth biggest investment bank in America. They provide loans. The housing market's hot. Analysts believe the company is giving loans to people who aren't reliable enough to pay them back. Uh-oh. The stock price has nearly doubled in the last year, and other analysts think it's going to continue to keep going up. So again, everything's looking peachy for this one. You're thinking I should buy this one and short the other one. But here's the problem. The first company was Netflix, when they were going away from sending DVDs and things to your house and going strictly online streaming platform. The other one's Lehman Brothers, who Netflix since then made the right move and changed with the times, and their stock has gone up, I believe, 6 or 7-fold since they made that change. Lehman Brothers went bankrupt, 2-0, nothing left. If you had stock in that, it is no longer any good whatsoever because they're no longer in business. So, again, sometimes the shorting, it can look like a sure thing, but it can be dangerous as well, so just be cautious. So with those, limitless amounts of money can make stock shorting really risky, so I, again, would not invite anybody to do that. I don't even do it myself. So, big ideas to wrap up. I told this wasn't going to be as long as yet. So, all investing that you ever make is subject to market cycles. Stuff's going to go up, stuff's going to go down. Don't think you have to sell it every time it goes down because, as history has said, it's going to go back up at some point, especially if you're diversified and not at all in one stock. The difference between time in the market and timing it is different. Time in the market, I'm letting my money sit in this, mutual fund or these stocks for 10, 20, 30 years versus timing the market and I'm trying to buy at the lows and sell at the highs and go back and forth. And I'm going to miss those dozen days when it goes up the most. So we got to be cautious of that. Risk is always going to be true, but there's ways to manage it. Diversifying, being in less risky items, like not individual stocks, maybe mutual funds, maybe bonds, maybe precious metals, which we're going to talk about next week, and kind of seeing how some of that stuff works. And then finally, shorting stocks does get a lot of press. Some people make a whole load of money on it. But for most, that's a terrible idea because, as they said in the video, you have an unlimited possibility of loss instead of just what you put into it, which can really be a rough thing for people as you go. So